So you have prepared your financial statements, your trial balance, profit and loss, balance sheet, and cash flow statement. But now comes the real question. What do these numbers actually mean? So today we'll go beyond the numbers and break down 10 essential financial ratios that help you diagnose your business health. We'll compare them to industry standards for a typical retail business so you can see where you stand and, more importantly, what actions to take if your numbers are too high or too low. Alright, so if you're new here, I'm Dennis Hilario and I give you my best thoughts and tips about business process improvement and digital transformation. Kindly consider subscribing or smashing the like button so it can reach to more people like you. So let's dive in. So let's start with the gross profit margin. So the formula for this is gross profit divided by revenue, and the result would be multiplied by 100 for the percentage. So as an example, if your gross profit is 300,000, revenue is 500,000, so pretty much your gross profit margin is 60%. The typical retail industry standard, 40 to 50% is the baseline. If it's higher than 50%, then you have strong margins. But consider competitive pricing or reinvesting in marketing. If lower than 40%, your cost of goods is too high. You may want to negotiate with suppliers or adjust pricing strategy. The second ratio is net profit margin. Formula is net profit divided by revenue. The result will be multiplied by 100 to get the percentage. So in this example, 150,000 divided by 500,000 will be equal to 30%. In a typical retail industry, 5 to 10% is the baseline. So if it's higher than 10%, then it's a profitable business. Congratulations. Consider expanding or investing in growth. If it's lower than 5%, then costs are eating into profits. You have to review operating expenses and your pricing strategies. The next one is about liquidity ratios. The question here is, can you pay your bills? The formula for the current ratio is current assets divided by current liabilities. So in this example, current assets is 280,000 and current liabilities 130,000. If you divide them, you'll get a 2.15 current ratio. In retail industry standards, it's 1.5 to 2.5 is the baseline. So if it's higher than 2.5, you may be holding too much cash or inventory. Try to reinvest in growth if you have this result. If it's lower than 1.5, then you risk cash flow problems. You can fix that by improving your collections or secure short-term financing. Ratio number 4 is quick ratio. It's what you call acid test ratio. The formula is cash plus accounts receivable divided by current liabilities. So in this example, 150,000 divided by 130,000 equals to 1.15. Again, in retail industry standard, 1.0 to 1.5 is the baseline. So if higher than 1.5, then you have too much idle cash. Consider strategic investments. If lower than 1.0, then there's not enough liquidity. Again, try to improve your collections or reduce your expenses. So now let's talk about efficiency ratios. How well do you manage your assets? Start with inventory turnover ratio. The formula is cost of goods sold divided by average inventory. So in this example, our COGS or cost of goods sold is 200,000 and our average inventory is 50,000. By the way, to get average inventory is like getting the difference of ending inventory of the year and then the beginning inventory of the year. The difference should be divided by 2. That's your average inventory for the year. So in this example, we have a result of 4.0. In retail industry standard, 4 to 6 times per year is the baseline. If higher than 6, so inventory is selling fast. But check for stockouts. Increase restocking frequency. If lower than 4, then you may have slow-moving inventory. Try to run promotions or optimize your stock levels. Alright, so before we proceed on the 6th financial ratio and you want to learn more about preparing financial statements and interpreting financial statements or, accounting lessons in general, check out my Accounting Starter digital course at accountingcourseph.com or click the link below to learn more. So, ratio number 6 is accounts receivable turnover. The formula is revenue divided by average accounts receivable. So in this example, say we have a 500,000 accounts receivable and 50,000 average accounts receivable. So in this case, we have value of 10.0. 8 to 12 times per year is the retail industry standard. So if it's higher than 12, customers pay fast but consider offering flexible terms for growth or more customer retention and acquisition. If lower than 8, then you're waiting too long for payments. Enforce stricter credit policies. Ratio number 7 is leverage ratios. How much debt do you have? Let's start with debt to equity ratio. The formula is total liabilities divided by owner's equity. So in this example, if our liabilities is equal to 130,000 and equity is 150,000, so your debt to equity ratio is 0.87. Retail industry baseline is 1.0 to 2.0. So if it's higher than 2.0, it's too much debt. Try to reduce borrowing or increase equity investments. If it's lower than 1.0, it's under leverage. Consider using low-cost debt for expansion. The next one is EBIT, so earnings before interest and taxes, divided by interest expense. So in this example, say your EBIT is 200,000 and your interest expense is 30,000, you have a 6.67 interest coverage ratio. In retail industry standard, 3 to 6 times is the baseline. So if it's higher than 6, it means business is stable. Consider refinancing for lower interest rates. But if it's lower than 3, it's a high debt risk. Try to lower expenses or increase your profits. Next one is cash flow and return ratio. Is your business sustainable? Let's start with cash flow ratio or operating cash flow ratio. The formula there is operating cash flow divided by current liabilities. So, for example, your operating cash flow is 150,000 and current liabilities is 130,000. Operating cash flow can be your net profit from your profit and loss. So, your OCF ratio in this case is 1.15. For retail industry standard, it's 1.0 to 1.5. If it's higher than 1.5, then you have a strong liquidity. Again, consider expansion or other opportunities for growth. If it's lower than 1.0, then cash flow problems ahead. Try to boost your collections and reduce your overhead. Okay, so last but not the least is your return on equity. The formula is net profit divided by owner's equity. So, for example, your equity is 150,000 and your net profit is 150,000. So, you have a 1.0 return on investment ratio. Sa retail industry standard is 15 to 25%. So, if it's higher than 25%, then you have a strong performance. You have to ensure sustainable profitability. If lower than 15%, try to improve further on efficiency or increase your revenue. Alright, so you use these 10 financial ratios to track your business's financial health and make better business decisions. Thank you so much for watching, and I'll see you in the next